Startup funding explained. Investment rounds and sources. A startup is always more than just an idea, it's also a lot of time and effort, dedication, focus, and of course, funding. Over 60% of all startups need external investments. For example, the average cost of developing a platform in the US reaches $75,000, which is not affordable for most startup owners. Raising the money, you have to understand the difference between different funding rounds, as well as investor types. Welcome back to another episode of Trustify. Subscribe to the channel now if you enjoy this type of content and hit the notification bell to never miss any of our latest videos that we upload. In this episode we will be going over Startup Funding Explained. Let's dive in. Startup Funding Rounds. First of all, you can't just get plenty of cash or a business loan and feel set and happy for good, although it sounds attractive, right? You have to go through a number of funding rounds and prove that your idea deserves the money, meeting different goals and challenges every time. Each round is designed to raise enough capital to grow further and can take as long as a year. However, many entrepreneurs rush things down to a 6 or even 3 months time frame. Based on the raising purpose, startup funding rounds are divided into the following stages. Pre-seed/seed, Series A, B, and C, and IPO. Seed stage funding. Pre-seed funding is when founders are trying to give their idea the initial push and often invest their own money. It is followed by the seed stage, where founders attract so-called angel investors. These people provide funds for further research, testing market needs, hiring a team, and production start. At the seed stage, tech startups can aim at anywhere between $500,000 and $2 million investments, depending on their needs and presentation. Investors are ready to take risks, and typically invest in a number of startups. Those that go through then receive additional capital. Some of the well-known companies considered for this stage are Y Combinator, 500 Startups, SV Angel, and Techstars. Series A. Next comes Round A. It is focused mainly on the startups that have a proven business model, decent customer base, and are already generating profit. The investments at this stage can start from $3 million and require a specific strategy to reach higher ROI. Typical investors here are venture capital firms that ask startups to show real data and progress received from previous investments. They want to see the startup turning into a valuable money-making machine ready to scale and get to the next level. Series B. Round B helps startups turn into enterprises. At this point, they've already matured, have a large user base, and are looking for VC-level participation. Investments at this stage can range anywhere around $10 million and up. Mixpanel raised $65 million Series B. This stage is all about scaling up the team and exploring new markets. Some of the biggest investors here are Excel, Insight Venture Capitals, and Sequoia Capital. Series C. Moving to Round C implies an even higher level of expansion. The companies are already successful, value $100+ million, and are aiming to receive equal funding. Again, Magic Leap has raised almost $1 billion. As one of the last funding stages, Round C includes not only extending current project capabilities but creating new products. So, prepare to work with the largest VC firms and corporate-level investors that are far more demanding. Companies at this stage are getting their exit strategies ready to smoothly approach IPO. IPO, the final stage of a startup's existence, initial public offering, IPO, is the process of opening a private company's shares to the public. This unlocks a vast amount of funding available on the public market along with a new level of transparency. However, it also means additional complexity because now you have to deal with shareholders in addition to investors. Such relationships require a lot of effort and you can expect it to be challenging and expensive. Fundraising for a startup requires a lot of time and a good strategy to reach the goal. Understanding each of the rounds will give you an advantage over competitors that simply look for any investment passing by. Startup funding sources. As a startup founder or CEO, you should have a clear idea about the investment types before actually raising the money. In this regard, there are 7 main options. Number 1, bootstrapping. Also known as self-funding. Perfect for early stages when you are just getting started and have enough money to cover the current needs, that is developing a business plan and creating a proof concept. These 2 elements become your main assets for acquiring future investments and the expenses are comparably small to cover from your own pocket. The advantage of bootstrapping is that you get tied to the business spending your own money, which is appreciated by investors in later stages. However, this is not an option for the startups that need money from day one or large businesses. Number 2, crowdfunding. Internet capabilities are unlimited. Crowdfunding has become a popular way of raising money as it doesn't need much to get going. The opposite of a traditional business route, here people pre-order your product before you even started building it. You then use the money raised for the actual product development. Small investments from a number of people on Kickstarter or Indiegogo can make a good starting point for your startup. All you need is to convince people with your business plan, a prototype, or a video where you describe your goals, timelines, and milestones. While there is always a risk of your idea getting stolen, this is still a great way to market your product. Number 3. Incubators and accelerators. Accelerators and incubators can be a great option for early-stage startups. Run by VCs, government firms, and universities, they can be found in most big cities, helping hundreds of small businesses every year. They aim at supporting a startup in its early stages through infrastructure, networking, marketing, and financial assistance. Often used interchangeably, the two terms do differ in functions. Incubators bring up startups like children from the very start to becoming a solid business, and accelerators help them scale up. Such programs have strong competition among applicants and take about half a year to help build good connections with mentors, investors, and other startups. And with that, we've reached the end of this video all about startup funding explained, investment rounds and sources. Get involved and let us know in the comments section down below. We hope you found this video helpful, and if you enjoyed it, don't forget to like and subscribe for more videos just like this. And turn on the notification bell so you don't miss out on our latest uploads. Thank you for watching, and we'll see you in the next one.